Welcome to The Close. I'm Roger Peterson. Thank you for joining us. Markets will be closing in a half an hour, but first, let's get to some of the stories we're following in the BNN Bloomberg newsroom. Bloomberg is reporting that Canada Pension Plan Investment Board has halted its sale of fund stakes anticipated to be worth about $1.5 billion US. Additionally, La Caisse is suspending an undertaking to sell an estimated $1.5 billion of Chinese private equity assets. According to the report, potential sales were stopped as buyers offered to take the portfolios at a discount deeper than expected. We are watching shares of Keyera, AltaGas, and CN Rail today. Alta down by 1.4%, CN up by 1.46%, and Keyera off by a half point. The companies are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million, and it combines Keyera's ACE Rail Terminal with CN's rail network and AltaGas's West Coast export platform. Companies say the project will strengthen Canada's energy competitiveness as well as expand access to global markets and support long-term economic growth. OpenAI is preparing to file for an IPO. The Wall Street Journal is reporting that the ChatGPT creator is working to make a confidential IPO filing as soon as Friday and is targeting a public debut that could come as early as September. The AI giant cleared a major roadblock to its IPO earlier this week when it won a legal fight with its former co-founder, Elon Musk. And take a look at the markets right now. They are on a bit of a rocket ride on the TSX. Pretty much everybody is well into the green, led by tech and consumer discretionary. Energy, though, is off by about a point. That's the only drag. And you can see it's up by about 1.4%. A lot of that being driven by the news that maybe there is a deal for peace in the Middle East. According to Trump, they may be close with Iran. In the U.S. markets, look at the numbers there. Similar situation. Everybody over at 1%. S&P 500 up 1% on the nose right now. It's 74.27. Dow over 50,000 again. And the NASDAQ is also up by 1.37%. at 26,222. Okay, the time frame for an end to the Iran war still uncertain, even as hopes strengthen amid talks between the U.S. and Iran. It's a good time to protect yourself with exposure to commodities, says my guest, Martin Pelletier, Senior Portfolio Manager, Trivest Wealth, Wellington Altus Private Counsel. Martin, thanks very much for joining us.
You betcha.
Another interesting day. I mean, the market's taking off on that news. I guess that Trump was saying that maybe we are closer to a deal with Iran. What do you do with all this?
Well, we have this push and pull market where one day we're having some sort of resolution in the Strait of Hormuz, and the next day not. I just really don't see anything telling me that we're going to get some sort of resolution in the near term. And bond markets are telling you that. More so maybe today was a little bit of a reprieve, both with stocks rallying and bond yields coming back off. But for the most part, bond yields are still quite high. In the U.S., 30 years, the highest level since 2007. And in Canada here, our 10 years, the highest level in 2 years. So bond markets are saying all is not well, especially with what's happening in Iran. And the equity markets are looking past that. So the big question is who's right and who's wrong?
And do you want to dare answer that question?
Well,
go on.
So I'm an investor in both markets. I tend to lean more towards the bond market. Bond markets tend to hold people more accountable longer term. They're holding governments accountable here. Obviously, their debt servicing costs are going up significantly, both in Canada and the U.S. and in the G7. And that's going to create a lot of trouble for their politicians and for Main Street. And the main drive of the economy is under significant pressure here. So I think that I'm looking more towards the bond market as being defensive with my equity positions in the near term, just until we get much better clarity than a rumor coming out of the White House.
And what's near term to you? A few months?
Yeah, well, no, we got to get this dealt with in the next couple of weeks. There was a NATO discussion saying if this isn't dealt with by July, we're going to have to step in. July is way too far along. There's going to be significant shortages in certain parts of Asia and even in Europe. Luckily, I haven't planned my summer trip to Europe this year. I did it last year, so I'd be a little concerned if I was, because they're going to have enough fuel to get me back home.
Well, hopefully. I mean, and I'm just looking at some of the oil prices right now. WTI for July is down nearly 10%. Brent off by 5.6. Okay, different numbers there. I had it up by 1.9.6, so off by 5.5. You can see the oil is reacting as well. Your thoughts on that? Do we see it returning to pre-conflict quickly if this continues, or again, we just kind of have to wait, don't we?
I think we're in for one heck of a ride. It's going to be all over the map. There are those with looking at the fundamentals and saying longer term, this price is way too high given where Main Street is at in regards to the global economy and their baseline. There are also those who have highlighted significant infrastructure damage and prolonged damage is being done as this continues. So I think we're going to see a huge volatility in pricing and oil prices, and that's going to create instability in the bond market. And maybe if this does continue, ultimately work its way into the equity markets. Not yet. So this creates trading opportunities for your followers that love trading oil. You can be buying dips and selling the rips, I call it, and positioning there. As a longer-term investor in the space, it makes it very difficult whether you want to continue to own energy longer term, because there's going to be tremendous ups and downs on that portfolio value every day, is what we're witnessing the last couple of weeks.
All right, and you think this current environment is challenging high valuation growth stocks? Are you going to be watching? I think everybody's going to be watching Nvidia, isn't it? What are you looking for?
Yeah, so that's a key driver. I mean, it's such a large company. It's bigger than many economies with its market cap, so it's kind of wild that way. Growth stocks have been able to, in rate-sensitive segments of the market, been able to shrug off what's happening in the bond market because the results have been really good. AI spend is significant, and that's generating some really good results. I probably think that NVIDIA is going to continue what we've seen over the previous couple of weeks in earnings, and that is being reflected in the markets, as you just mentioned before me coming on, setting highs here. And that just makes me a little antsy because there's this geopolitical aspect, and that you look at the level of uncertainty, the uncertainty index being at all-time highs, compared to tech stocks that are just driving and plowing through all of this. We better get a resolution. Yields better come back down, because if we're having the same discussion in July, we're not going to be talking about new highs being set.
All right, and you are increasing commodities exposure, and you like WSP Global. Tell me why.
Yeah, and so these commodity stocks, gold, uranium, copper's done well, but gold and uranium, some other commodities have sold off with a stronger U.S. dollar and higher yields in the U.S. If we do get some sort of resolution, which we do need, it doesn't take away the sovereign debt risk that's still occurring. Maybe the longer this goes on, it creates more sovereign debt risk. And that means countries are going to have to print money again to substantiate their deficits, unless they cut their deficits. We're not seeing that in Canada, and we're not seeing that in the U.S. That means more money printing. That means that's very supportive for gold, for example. Uranium, the AI build-out, nuclear power, great positioning around that. Uranium, like Cameco is a position of ours, is down 20% from its January highs. We think that's a good second chance to get in. And then WSP Global, the infrastructure space, that stock in regards to Stantec as well, been hit hard as people believing that AI is a threat to their engineering work. On the flip side, AI augments rather than replaces their physical build out. And we think that, look at already 1/3 of their platform already sees double-digit asset growth from AI-related spending demand. So we think the market is probably getting that one wrong. I'm not going to fight the market, but when sometimes the market isn't always right, there's ways to make money, and that's one way that we're looking at.
Okay, we have to wrap it up there, Martin, but thank you as always for joining us.
You betcha. Take care.
Cheers. Martin Pelletier, Senior Portfolio Manager, Trivest Wealth, Wellington Altus Private Counsel. Coming up, Agnico Eagle is making a major bet on Canada's North, greenlighting its Hope Bay project in Nunavut. When we come back, we'll speak with the CEO on what drove the decision. Agnico Eagle is placing a massive bet on the Canadian Arctic. The gold giant announcing yesterday that they are greenlighting a $2.4 billion U.S. redevelopment of its Hope Bay project located in Nunavut, one of the biggest capital commitments in the mining sector this year. We got more from Agnico Eagle President and CEO Amar Aljundi.
This is a fantastic project. It will be producing almost 450,000 ounces a year at cash costs about $950 US dollars. So, Roger, the cash generated by this, based on current prices, is in excess of $3,500 US per ounce. You work out the numbers. That's about $1.3 billion US every year of cash generated. So. You might say it's a bet. I think it's a pretty fantastic bet, and it'll make a lot of money for our owners. At the same time, it's great for Nunavut. This will be our third operating mine in Nunavut. To put this into perspective, Roger, we represent about 25% of the entire economy in Nunavut. We purchase and do business with over $1 billion US in local entities. We employ 3,700 people up here. We pay about $600 million a year US to various Inuit organizations. And finally, this is great for Canada. This is a large investment, a large industrial investment, a large economic investment, and for the communities in a very strategic part of Canada's north, right on the Northwest Passage. So it's a great investment for our owners, it's a great investment for the community, and it's a great investment for Canada.
Now, you've got the other two mines going up there. Do you see it being fairly similar, or are there new challenges on this one?
This will be the fourth mine we've built in Nunavut. We've been here for 20 years. The process plant is really just a copy of something we've just built at Meliadine, which is also in Nunavut. So Agnico Eagle, I'm proud of everything we do around the world, but I think we are exceptionally good at operating in this kind of environment. Again, we've been here for over 20 years, and we run a very successful business in Nunavut.
And I guess one of the things always is power up there, energy costs up there. Do you expect to be, you're looking at the $25 million federal funding from the government and a 37 megawatt, diesel plant and the 4.2 megawatt Inuit-led wind farm. Is that going to be enough? And diesel, how much of a concern is that? It's I believe 10% of your operating costs?
Yeah, roughly. So the diesel in this part of the world, you're not connected to any hydro grid. It's just the distances are massive, as you can imagine. So we operate primarily with diesel. We've been doing that for 20 years. The one thing I would say as an engineer is, while we operate with diesel, we can run much more efficiently because we take all of the heat off, take the engines to heat the plant and heat the people, the accommodations, etc. But you raised a very interesting point. The government is helping us to put in place, well, actually it's helping the Inuit community to put in place a windmill. It'll be owned and operated by the Inuit communities. We will buy power from them. So it not only allows us to have green energy, but it creates a long-term sustainable business for the Inuit communities around us. And we're starting with one windmill, but we're hoping to have up to 5 or 6. And if we get those 5 or 6, that will be enough effectively to supply power to the entire mine, clean power, and a lot of long-term revenue and business opportunity for the Inuit communities to add to what they're already working with us.
And you have it, you expect 11 years initial lifespan. Do you think you can expand that? And where do you get the confidence for that?
This is going to be, in my opinion, a multi-decade operation. The way it works, Roger, is you spend money exploring. We've hit this very hard. We acquired this 5 years ago from a company that was going to be a Chinese owner, and the Canadian government wasn't comfortable with that given the strategic location. We acquired this 5 years ago. We hit it hard with exploration. We've got a project now that is very profitable, but the way it works in our business is you do exploration until you know you have a profitable project, then you move forward. We have only just started to scratch the surface on exploration. We're only at the first 12 kilometers of 2 parallel 80-kilometer greenstone belts. The areas that this first 12 kilometers are still open at depth. So we are exceedingly confident that this is going to be a multi-decade world-class mine.
And that was Agnico Eagle President and CEO Ammar Al-Jundi. Coming up, we'll look at how the Strait of Hormuz and higher bond yields are impacting mortgage rates in Canada. Stay with us. Bonds are selling off around the world as investors worry about how the conflict in Iran will affect inflation. While StatsCan posted cooler than expected inflation data last month, it was still up, and investors are still concerned that the Bank of Canada could avoid cutting rates if the war in Iran continues. Here to tell us how lower bond prices are impacting mortgage rates in Canada is Ron Butler, mortgage broker at Butler Mortgage. I guess depending on the moment, lower bond rates, sometimes it's higher bond rates with what everything is unfolding right now. Ron, thanks as always for joining us.
Well, we've had a steady increase from February. We're up about 60 basis points on yields, and we have a corresponding impact on mortgage rates, about point for point.
And so where are they at now, fixed rates? And how, are the variables staying kind of in lockstep or at all, or is it variable all over the place depending on?
Variable has stayed down.
Yeah.
I mean, variable is 100% a function of the Bank of Canada moves, and there's been no moves. So we have variables, say, around anywhere from 3.30 to 3.60, 3.65. Bond yields, when we looked at fixed rates back in February, a lot of 3.69, a lot of 3.79. No more of that. No more of that. We're all 4.49, 4.69. So yeah, it's been a significant jump.
And so what are there different roads we can take here? I mean, does it really depend on what happens in Iran? Is that the factor right now driving everything?
Yes, that is the overriding factor. I mean, the Straits of Hormuz equal higher oil prices equals higher bond yields from inflation equals higher mortgage rates. It's just a straight line. You can see it.
And I mean, today we heard news, and we're seeing the markets react to it, but we've heard that maybe we might have another deal. Who knows? We'll see what happens. But how long would it take for the bond markets to react to that if there is and the Strait reopens?
I mean, the bond markets will react. It won't be instantaneous. There will be a drop. The most important thing possibly is it takes the Bank of Canada out of the potential for an increase this year. So that's very meaningful. It would allow people to seek the safe haven of variable rates. Mm-hmm. And I think that would turn out to be a good option once the war comes to an end. The bond yields aren't going to drop overnight. The price of energy is not going to drop overnight. So it'll take a while, but variable can become a very safe bet then.
At that point. And how much does the bank want to avoid an increase? Does it? Or is it just, I'm the bank, not I'm the bank, but we're the bank, we have to do what we think is right?
I think that's true. I think that if inflation is persistent, if the war goes on for months and months and inflation is persistent, I believe the bank just has to respond to its function. The Bank of Canada's got to raise rates. But I don't believe the Bank of Canada has any desire to raise rates. I think, Tiff Macklem has signaled it many times. His view of the economy is it's weak, mm-hmm. and therefore there's no need for a hike, unless inflation makes it impossible.
And does the bank, is there any ever pressure from what the U.S. does on Canada? Do we have pressure on the Bank of Canada?
Well, we've seen their yields have gone up significantly. Their mortgage rates are much higher than ours. There's some mortgage rates in the U.S. right now in the 7% range, so it's a significant problem for the U.S., which is maybe another reason we can assume that there will be a deal eventually. It's mm-hmm. bad for the U.S. economy to continue the war. But yeah, I think we can say for certain that a long duration of the war will mean we will have higher mortgage rates, fixed rates, for quite a while.
And that, you say that could actually slow down the housing market.
I think we're actually in a way seeing it right now because there's a bit of a bump in sales. And I would suspect most of those people had pre-approvals from weeks ago where they had a 3%, a rate that was in the 3% range. So now they're eager to get a house settled in order to hold on to that rate. So we might be seeing a little bump now, but if these rates persist, if a rate close to 5% develops or at 5% develops, we'll definitely see a tamping down on the housing market for sure.
And is there a large number of people that would have tried to get that rate and start looking?
Well, if the people were interested, they did get that lock-in. If the people were serious about shopping, they got that lock-in. Now they've got a time set. They've got to move quickly. That's why I suspect we will see a bit of a bump in the next few weeks in sales. Not necessarily prices, but sales. But yeah, if we hit 5% on fixed rates, definitely a slowdown in house sales.
And if we see 5% variables, if you're looking to buy, what would you do with that? Do you go variable at that point, or do you short-term?
It's a great question, but it's one of the strangest events in my career, 31 years in the mortgage business, that Canadians have to think about a war in the Middle East to make a decision about their mortgage rates. It's really odd, but look, if you end up having to make that decision as a consumer, as a borrower, you have to say to yourself, well, I think the war will end soon. I could probably live with variable. I think the war will go on long. I may need to provide the safety of a fixed rate. I gotta say, it's a very unusual time in the mortgage world right now.
Okay, with a lot of focus then on rent, is there any other factors that could sneak in or are kind of sitting in the background?
Definitely. We've got, if you think back to last year, we had a lot of noise about bond vigilantes, about those traders who think, look, I don't think the kind of wild fiscal spending we've had these days from governments is sustainable, and we may need to really think a lot about where we should be. How should we examine this risk? How should we price it? And in those situations, that's an extra pressure on upwards on bond yields.
All right, and that though, everything is Iran.
The majority of the reasoning is Iran. As soon as you see any kind of rumor about a settlement, I think you see oil prices drop and you see bond yields drop.
And people exhale. Okay, we've got to wrap it up there, Ron. Always a pleasure. Appreciate you coming in, sir. Thank you. That's Ron Butler, mortgage broker at Butler Mortgage. Up next, the closing bells on Bay Street and Wall Street. And those are the closing bells at the NASDAQ. Euronet rings in the closing bell for the New York Stock Exchange. It's the Timken Company. It is a good day for them to be ringing that bell. And TSX, Baycrest, Bite for Brain Health, is closing the market there. And you're watching the close on BNN Bloomberg. I'm Roger Peterson. Here's how we close the day on Bay and Wall Street. It was quite the day for the markets on the news. It looks like there may be possibility of peace in Iran. Maybe the Strait of Hormuz will reopen. And look at those numbers right there. The TSX back up above 34,000 after having its two worst days since April, up by 1.25%. The S&P 500 above 7,400. It was up more than a point. And the NASDAQ was on fire today. Up by 1.54% at 26,270. Of course, we are awaiting NVIDIA's earnings report coming up in about 19 minutes. Now, leading the TSX today, Go Easy, which has been on a wild ride, of course, on those earnings reports and concerns it had. It was up 11.8%, but look at that for the year. It's down 76%. Perpetual Resources also finishing the day up more than 11.5%. It's having a better last year. It's up 127%. And Seabridge Gold as well, worth noting. And it's up nearly 11%. Now going the other way, Allied Gold Corp. It was up by 4.6%. Vermilion Energy about the same, 4.6. The losses weren't so big as the gains today. And Strathcona Resources, last one we want to mention, it was off by 4.9. So those were the downs for the day. And for more on that, we're joined by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, thanks as always for joining us. All right, let's talk a little bit about Seabridge. What was going on there?
Yeah, that's right. So a lot of the movers today were directly tied to this prospect of optimism around potentially an end to the Middle East conflict. So Seabridge was one of the top gainers on the TSX. It was just beaten out by Perpetua Resources as the top performing precious metals company at the end of the day. But still, shares jumped by over 11% today, and that marked the precious metal miners' biggest advance since January. A lot of that had to do with the rebound in gold prices themselves this afternoon. That came after President Donald Trump said the U.S. is in its final stages of the conflict with Iran. So that caused the U.S. dollar and treasury yields to retreat, which gave room for a lift in gold prices to about nearly 2% at its highest point. It also helped ease some concerns that the Federal Reserve may potentially raise interest rates in reaction to the inflation shock caused by the Middle East conflict. And for viewers who don't know, gold tends to thrive in a low interest rate environment as a non-yielding asset. So traders have been clearly looking for more clues about the potential end of a Middle East conflict or the conflict in the Middle East. And more importantly than that, the reopening of the Strait of Hormuz, which could ease inflation concerns and then lower the likelihood that we would see central banks just raising borrowing costs. So it's not just Seabridge that got a rally today as a precious metals miner. You mentioned Perpetua Resources. That was also a beneficiary, but there were also some other TSX listed gold and silver miners like First Quantum, First Majestic, and others. So it was one of those days where silver and gold had its shine, and some of the companies were in the top 10 performers on the TSX today, Roger.
All right, and one other note, Vermilion Energy as well, optimism there. Oh, actually taking a hit, I should say, taking a hit on that. I was getting a little too optimistic. I thought everybody was having a great day. Vermilion Energy, Vermilion Energy, not as much.
Right? Yeah. So Vermilion Energy, so the same optimism that drove gold prices higher hit oil prices, and that hit Vermilion Energy to the tune of about 4% at its lowest point today. That was its biggest ding in about 2 weeks. So what happened there was the prospect or the potential reopening the Strait of Hormuz would bring some more global oil supply onto the market, and that would in turn lower oil prices. So the idea of that is obviously having an impact on the companies that produce oil and gas. And so energy producers like Vermilion Energy and other TSX listed names like Cenovus, Strathcona, and others found themselves among the bottom of the worst performers today, Roger.
All right. And I guess not that surprising considering the news. Stephanie, thank you for that. Appreciate it.
Thank you.
Bloomberg's Stephanie Hughes. And joining me now for some movers south of the border is Bloomberg's Avalon Purnell. Avalon, thanks as always as well. Good to see you. We have a mixed bag, but Target had a better than expected quarter. Some people welcoming that. But the shares still facing some pressure.
You're absolutely right. Target fell about 4% into the close today. That's after management offered fairly cautious commentary after what was a really great first quarter. Target reported its best comparable sales growth in over 4 years, and executives warned of tougher comparisons heading into the current quarter, which is the second quarter right now. One of the other things I thought was really interesting is that Bernstein was writing in a note that they expect the sustainability of that first quarter beat to really be the biggest question in investors' heads about where will they go from here, and what is the timeline for a turnaround for Target? Still seems to be a little bit tough to see.
All right, and TJX, I wanted to say the TSX, TJX shares stronger today after their earnings.
Absolutely. TJX climbed nearly 6% to notch its biggest one-day jump since 2024, and that's after a much better than expected quarter. To the people who may not necessarily be familiar, TJX is the parent company behind brands like Marshalls and TJ Maxx, and they boosted their full-year sales outlook as more cautious shoppers decide to pick their stores as opposed to main brand options. Jeff Fries is writing that the beat and raise quarter really highlights the strength of off-price companies like a TJ Maxx or Marshalls. Also worth noting that TJX says that their full-year outlook does include higher fuel costs for the rest of the year. So that's definitely something we've been keeping our eyes on in terms of how will this Iran war impact various consumer companies. At least for them, they're already factoring that in.
All right, and Hasbro off sharply today. I don't think a toy maker should be allowed to lose money. That just doesn't seem right.
I think I'd probably tend to agree, but as you mentioned, Hasbro did drop nearly 9% into the close, and its worst one-day drop in over a year. And that's partially after the toy maker also offered fairly conservative guidance coming out of that print. And that's very much leaving investors puzzled, especially after they had a lot of strength in its digital gaming segment. One thing to call out as well, that Morgan Stanley is writing that investors remain focused on the full year outlook and whether it reflects the typical management conservatism that they've come to expect from Hasbro, or if it reflects deeper issues potentially from the macro environment. Again, drawing from the Iran war conflict of whether these families are still choosing to buy games or whether they're being a little bit more money conscious now and kind of keeping those coins within their pockets.
All right, Avalon, we have to wrap it up there, but thanks as always for that update. Bloomberg's Avalon Purnell. Up next, NVIDIA reports earnings after the bell. We have more on that after the break. All right, looking ahead to NVIDIA's earnings, which are set to come out in about 10 minutes. There's one question on investors' minds. Is this just another brick to add to their wall of worry? Joining us now, Michael Monahan, partner and portfolio manager at Founder ETFs. And Michael, thanks very much for joining us.
Thanks for having me. Glad to be here.
Okay, NVIDIA, what are you looking for? What are you expecting?
So I think it's both about watching the numbers, but watching the intangibles as well, looking at the ecosystem that Jensen's building out, right? His token factory. So from a numbers perspective, we'll be looking at gross margins. We want to see 75% gross margins continue, showing that the Blackwell to Rubin transition is smooth. And then it all comes down to guidance after that.
And do you feel that's attainable, the 75% on the gross margins? Have they been moving things?
That's certainly what it sounds like. If you went back to Jensen's keynote back in March at the GTC conference, he talked about the fact that they were already making thousands of units per week of the new Rubin products. So we feel comfortable that they can meet the margin forecast. We'll certainly see the print here in a few minutes.
I know everybody is waiting for this, and you think it could move mid-single digits on a beat. What do you think would disappoint the market? We've seen it before with these companies.
Yeah, so I think the biggest disappointment would be on the margin side. If they can't hold gross margins flat, that would show that perhaps there's been a pull in or pull out of the transition to Rubin. And then certainly, Jensen and his team certainly do a great job of managing expectations, but we've seen the street creep up, right? And so, the whisper numbers have crept up a bit above guidance in the forecast. And so we've got to make sure it's not just about beating and raising this quarter. I think it's got to be a healthy beat and raise. But I think it's also some of the intangibles. Are we going to hear about higher attach of NVLink? Are we going to hear about higher attach of Grok? Are we going to perhaps get our first forecasted on contracted customer backlog? So I think there's a lot of things that could move the needle positive for NVIDIA. So even though the last few quarters, the beat and raise wasn't enough, we think the setup this quarter will be enough. And we're hoping to see the good numbers follow through. We're very long-term investors, so we care more about attach rates and the product transition, but we understand the others that have a shorter time horizon.
Okay, we're going to get in a couple other tech giants, I guess. Oracle, you say it's misunderstood. What's the market missing in its role in AI?
So we think Oracle is going to play in the boring infrastructure side of the business. Larry started early building out and the ecosystem to build more and more of these data centers. That's what punished the stock, which caused it to trade off and re-rate. We think the street is now understanding that these bottlenecks within infrastructure are very important. And we think Oracle is very well placed to take advantage of the infrastructure bottlenecks.
And with that bottleneck, is it set? It's set to go. Then you think that you don't see any potential headwinds for it?
Certainly, they'll have to execute. They'll have to solve the problems, right? Getting power to the data center, but we've seen them be very creative. For example, their large Bloom install has shown that they can deliver power to the facility, and that allows Jensen to do his side, and that's to deliver the tokens at the lowest possible cost, coming out of the data center to turn those tokens into revenue.
All right, and Palantir, now I want to talk about that. You think investors are underestimating it?
Yeah, look, if you look at the last 2 quarters, Q4, they had a rule of 40 of 127, then moved to a rule of 40 of 145 last quarter. Those are just eye-popping numbers. But we do see that Alex's loyal shareholder base has been chasing some of these new sectors, the SOCs, the semis, the microns, the SanDisks. And so we think that Alex may have to put up another quarter or two to really bring in new institutional investors to backfill for that retail base. And we think that gives our investors and other patient investors in Palantir a really good opportunity to buy a very high growth stock that previously had been incredibly expensive and is now growing into its valuation.
And software, still bullish on it. Its death has been greatly exaggerated.
We certainly believe, as Mark Twain said, the death has been greatly exaggerated. We think we've moved past the re-rating period as people worried about terminal values, and we're going to start to see these strong revenue expansion, margin expansion, and we think that enterprise software, people will realize, is not going away. It's going to be the trusted endpoint into the data that's held within corporates. That's what the AI models will plug into, and we think that enterprise software will be needed more in the future, not less.
And is there going to be, can everybody win in that, or are there people going to be left behind?
We think there's a bifurcation. The names like Salesforce and Palantir that bring a really differentiated product, we think will win. And we think some of the Me Too light wrapper companies could face headwinds. So we don't own those stocks. We're going to own the Salesforce, the Palantirs, the Zscalers that have a sustainable edge.
All right, just one last big market picture. What's one of the biggest risks you think investors are underestimating right now? I mean, it feels like there's so many things you can choose from almost.
We see 3 waves that investors are watching, including ourselves. Wave 1 is the Middle East instability, although it looks like we're getting some resolution on that. We hope that happens to stabilize energy prices and inflation. The second one to the upside is the hyperscaler build-out. And the third one is the potential job losses from AI. So at any one point, depending on which one of those waves is moving through the market, it's certainly influencing investor behavior.
Okay, we have to wrap it up there, Michael, but thank you very much for joining us.
Great to be here. Thanks for having us.
Michael Monahan, partner and portfolio manager at Founder ETFs. With the World Cup just weeks away, CTV's Heather Wright breaks down the list of the most expensive cities to watch the World Cup and how it's impacting fans who already call those cities home.
The World Cup is the biggest sporting event on the planet, and this year's tournament will also be the most expensive, with the average ticket price in some host cities, including Toronto, sitting at well over $1,000.
It's the most expensive World Cup for a long time, and yeah, fans are being priced out of being able to go to the game they love.
According to a new study, New York has the highest ticket prices, an average of $1,700. Guadalajara is next at just over $1,500, followed by Dallas at $1,440 and Mexico City at $1,300. Toronto rounds out the top 5 with tickets averaging just under $1,300 apiece. At an average of roughly $500, tickets are more affordable in Vancouver, but the city tops the list when it comes to most expensive accommodations, with fans forking over an average of $922.71 a night for a 3-star hotel room. That's nearly double the cost of staying in the next most expensive cities, Seattle and New York. In Toronto, an average hotel is just shy of $300 a night. According to Destination Vancouver, the city has not yet seen a World Cup hotel bump, with bookings down 20% this year.
We've heard a lot of different things. It's all speculation. We know it's going to be a busy time.
With 23 days to go until the World Cup kicks off in Canada, tickets are still available in both Toronto and Vancouver, including for Canada's opening match on June 12th. But they cost upwards of $1,000 apiece, pricing out many would-be attendees, including Angela O'Hara, who lives in Toronto and won't be going to any matches. But she is excited for the beautiful game to come to town.
Just being downtown with all the excitement, you can't beat it.
When it comes to food, the least expensive host cities are all in Mexico, with Toronto and Vancouver in the middle of the pack. Miami is the most expensive host city to dine out in. Heather Wright, CTV News, Toronto.
Up next, we are moments away from NVIDIA's latest earnings results. Stay tuned to learn how the global chip giant performed in the first quarter. We're back in a moment. All right, the numbers are in for NVIDIA's latest quarterly results, and Q1 revenue topping expectations, $81.62 billion. The estimate was $79.19. Data center revenue beating the estimate of $73.48 billion, coming in at $75.2. So to discuss the earnings, the numbers, we're joined by Hatem Diab of Gerber Kawasaki, an NVIDIA bull, and Jay Goldberg of Seaport, known around Wall Street for his cautious view of the stock. We want a friendly conversation today, gentlemen. Thank you both for joining us today.
Thank you. Thank you.
All right, Hatem, we'll give you first chance here. You're just seeing the numbers, your thoughts on them, and still bullish?
Yeah, I think, NVIDIA is really the main player in AI, and every quarter we see them just crush the numbers. I mean, they basically grew 100% year over year. Margins, I haven't looked at the exact margins, but I'm assuming they're also beating margins. So I think we're just getting started in this AI boom, and NVIDIA would be the main player in it.
I'm just looking at adjusted gross margin was 75%. Just trying to see what other numbers I can pull up quickly. 75% adjusted gross margin. So.
Yeah, I mean, that's incredible, right? For a company at that size and scale to have those margins is really incredible. We've never seen something like this.
And so do you feel it's meeting all expectations? And Jay, we're going to bring you in 1 second, but do you feel it's going beyond the expectations then?
Expectations were high going into the quarter, as they've been for the last few months, because everyone is watching this company, but they've beaten on all numbers. So yes, absolutely.
All right, Jay, your initial reaction to the numbers we're seeing.
So far, so good. I haven't had a chance to read through all of them yet, but I agree. They beat numbers every quarter, and nobody seems to care. I think the problem the company faces is expectations are very high, and it's very hard for them to continue to beat them to the level people want them to. And so it's a good company. They have good numbers, but I don't see anything yet in these numbers that's going to alter that trajectory.
What do they need to do to make you a believer?
I just think there are so many headwinds now. There are so many constraints across the industry. They can't produce as many chips as they want. They can't get the allocation from TSMC. And as a result, they're leaving money on the table, which is opening the door to competition. And it's getting harder for them. And so what I really need to see is something new, some meaningful contribution from their Grok acquisition. There's a lot of things out there, and I just don't. It's not easy for them. It's not easy to be the king.
And Hatem, do you think this is leaving them vulnerable to competition?
No, I think what's happened is NVIDIA has done well on the training space, and their tech stack, from their software CUDA to their chips, have been really the go-to for all trainings. And now that AI has been proliferating and inference has becoming really monster that needs to be fed, NVIDIA with their Grok acquisition and obviously with their new Vera Rubin platform, which is 10x more efficient in token pricing, would also rule inference. So I think the reality is, as we evolve and as all these data centers get installed and really deployed, we're just going to see more usage and more need for both their chips and their services. So for me, this is just the beginning, as I said.
So you think, that $1 trillion is just the base, but Jay, Is that do you disagree with that, or do you what do they have to do to build from that 1 trillion? What a number!
I think inference is where the game is. But it's very much a jump ball. Inference means it's going to be the inference market is going to look a lot different than the training market where NVIDIA has dominated. There's a lot more demand for true agentic CPUs, and NVIDIA doesn't have those yet. I mean, they could, but they don't have that. They're not participating in the same way. I think there's going to be lots of different flavors of inference, and as much as in Vera Rubin, their current system looks fantastic, and they have a roadmap going forward. The competition isn't standing still. Google's TPUs are very solid, and AMD is coming on strong later this year. So I think it's just getting harder, more headwinds for them.
And one of the things you have concerns about, supply bottlenecks?
Yeah, my colleague and I have a list of industry constraints, and there's 25, 26 items on that. Just go down the list from, very, precise chemical inputs all the way through to more prosaic things like, electrical transformers and just electricians in general. I think there's a lot of constraints in the industry, and working through them is not going to be easy.
Hudson, what do you think of that?
Well, I mean, there's truth to the fact that when your business triples or quadruples over 2 or 3 years, there's going to be some constraints. But the reality, like the only place that's making money in the economy is really AI infrastructure build out, right? So every company that's in this space is actually ramping up, and NVIDIA is doing a really good job building the various kind of systems in place to be able to minimize those constraints. You see this with memory, for example. Memory has been a hot sector, and NVIDIA is the one that's been able to coordinate with the main memory players to be able to increase supply and so forth. So the reality is, if you're building a massive data center, spending $50 billion or $100 billion, you want to go to the player that can actually coordinate and help you build it and architect this massive project, and NVIDIA is the place to go.
Jay, you want to respond to that?
Yeah, I would say there's no question that NVIDIA has been executing like a machine, great execution. The problem is we're in the realm of factors that are beyond their control. Right. Take memory, for example. There's very likely to be a strike at Samsung's memory plant, just as Samsung is ramping memory for NVIDIA this year. It's not an easy thing for NVIDIA to fix. Does that cause a delay in their deployments? Possibly. Does the street care? Probably not. But it's just these things start to add up after a while.
All right, and a question for both of you, and I'll let Hatem, you can go first. You say NVIDIA's customer list is expanding, not shrinking, and where do you see it coming from? Because we heard Jay saying that they're facing some competition. How are they expanding it?
Yeah, well, initially it's mainly the hyperscaler, right? Like the Amazons, the Facebooks, the Microsofts, even Google actually is a customer of NVIDIA. But now you're seeing sovereign AI, you're seeing all the large language models ramping up their data center. For me, I think every company has to be in the AI business. So every day you're going to see more people coming in and looking for more compute, which just broadens their customer base and really diversifies it, and that's really good long term.
And Jay, you say AMD and Intel, they have a strong opportunity with their chips. They're now pretty close to competing.
I think AMD is very strong on the GPU side with their MI450 series. Beyond that, I see Google TPU, Amazon Trainium. We can even throw Cerebras into that list. It's a lengthy list, and it's growing.
And let's talk a little bit about OpenAI. Hatem, what do you think of that relationship? And Jay, I'll ask you the same question after.
It's a great relationship. Actually, OpenAI delayed their data center build-up with Oracle to wait for the Vera Rubin architecture because they believe it's going to be much better for their new frontier models. Again, I think if you listen to the people at Anthropic, and we work with some of them, and OpenAI, their biggest constraint is compute, and NVIDIA can deliver. But the reality also, having more providers of compute like Google and Amazon, I mean, the Trainium chip, as Jay was saying, is actually proving to be a good thing. Is good for the whole AI build out because we need more compute. We need a lot more than any of us think, I think.
And Jay, your thoughts?
I agree. AI is important and it's powerful, and there's a lot of demand for it. The problem is NVIDIA can't supply all that demand, and so customers are turning to alternatives. NVIDIA's leaving money on the table.
All right, we're going to wrap it up there. You guys can continue the conversation over a beer a little later, but and for joining us today, we appreciate it. That was Hatim Diab of Gerber Kawasaki, NVIDIA Bull, and Jake Goldberg of Seaport around Wall Street for his cautious view of the stock. Up next, we'll hear from the CEO of McLaren ahead of the Indy 500 and the Canadian Grand Prix. Stay with us. Keyera, AltaGas, and CN Rail are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million, and it combines Keyera's ACE Rail Terminal with CN's rail network and AltaGas's West Coast export platform. The companies say the project will strengthen Canada's energy competitiveness as well as expand access to global markets and support long-term economic growth. Meta has begun a round of layoffs for thousands of employees. The previously announced restructuring will cut 8,000 jobs globally and aims to reduce costs as the tech giant invests heavily in artificial intelligence. According to reports, Meta's latest round of cuts is expected to hit its engineering and product teams. Additionally, more layoffs could come later this year. Samsung could be facing new risks after talks between the electronics company and its largest union broke down. Samsung has failed to meet wage negotiations, fueling the lingering dispute. The move puts the company at risk of production delays and complicates development of semiconductors. Well, ahead of this weekend's F1 race in Montreal and the Indy 500, McLaren CEO Zak Brown joined Bloomberg Open Interest to break down the team's hunt for motorsport's Triple Crown. Take a listen.
We have an awesome driver lineup. We've got 4 cars qualified for the race. We've finished second twice in the last few years.
Coming up this weekend.
At Indy, we've crashed going for the lead, so we're so close. So this weekend I'll be at the Indy 500 and spectating from the Montreal Grand Prix. Fortunately, I've got great racing teams that do not rely on my attendance for success.
You've invested a lot into this. I mean, you're building a new facility in Indianapolis. Matt mentioned the hypercar in Le Mans, but also in other ventures. You're invested in the F1 Academy and having women rise through the ranks there. What are the economics of that? Because obviously F1 can command huge price tickets, whether it be private equity interest or sponsorships. What about these ones that don't have as big of a viewer base? What is sort of the cost-benefit analysis of putting this big of investment into them?
So they're all they all stand on their own two feet. So they all have to be proper businesses. Of course, Formula One, the size and scale is unlike not only any other motorsport in the world, kind of unlike any other sport in the world. So that's in a league of its own. But when you put them all together, it gives us a unique selling proposition, if you'd like, being the only team to have won the Triple Crown, the only team competing for the Triple Crown. It provides opportunity for our sponsor partners who want to get into different aspects of what these different series deliver. It's great opportunity for our employees. People want to move around, look for new opportunities, and most importantly, it's very exciting for our fans. You know, it's like 1 + 1 + 1 = 5 when you put them all together. You know, when we get that next leg of the Triple Crown done, that third race, whichever one that is, whether that's Le Mans or Indy, I think it will just have that much more excitement to it. And at the end of the day, we're all about our fans.
By the way, so in Formula One, we've seen some crazy new rules and powertrains. All Matt has done over the past months is complain about the new rules. It makes me just to set the context for you, Zach. Let's just say the first race made me very unhappy. I think it's getting better. In WEC, obviously, engineers are incredibly important, right? They're hypercars, and you have 3 drivers. In Indy, is that the one where the driver matters the most?
Well, I think in any form of motorsport, that you have to have the best drivers in the world, because no matter whatever the regulations are, the best drivers you need because all the teams are fantastic. So IndyCar, as you rightly said, is a spec series. We use a single chassis, so it becomes much more about setup and strategy of the race car versus development of the race car, where Formula One is the ultimate in development. The car, about 80% of the car changes over the course of the year, and then the World Endurance Championship, the hypercar, is almost kind of somewhere in the middle. But, you know, when we're building racing teams, the first thing on the shopping list is get the best drivers in the world, and no matter what series you're in.
The other big change for F1 this year, and it's the thing that's been out of everyone's hands, is the disruption for the races in the Middle East. And it really, really changed the calendar. You had this big gap, which I'm sure is different for teams and maybe taxing. And for fans, they have this big gap, too, where F1 isn't at the front of their mind. Obviously, safety is the most important thing. Course. But how has that changed this year? We went from a race calendar that was so incredibly busy to one that felt very spare to start the year.
Yeah, it was, it was obviously very unfortunate. We all want to go racing. You know, we weren't any less busy because you're constantly developing, you're in the simulator, you're developing your race car. So some people said to me, so what are you doing with your time off? And I was like, well, there's no time off. You know, we have the benefit of, you can tune in and watch us go IndyCar racing and things of that nature. So I think there was still plenty of content for fans. It was unfortunate. I hope we get one or two of them back on the schedule. It is a long schedule. So it gave us a chance. We had an accident in Australia. We needed to understand the power unit a little better, so we were able to take advantage of I wouldn't say the downtime, but the non-racing time, and we came out very strong at the following race, and we're so close with the last couple podiums to winning a couple races. So I'm excited, and I think these technologies, anytime you bring out new technologies, everyone has to understand and kind of massage them, and I think what you said was it's getting better. For sure it is. The racing's very exciting on TV. The drivers don't necessarily love how they've had to adapt their driving, but I think we're working closely with the FIA. We made some regulation changes in Miami, which was a step forward.
Miami was awesome.
Yeah, Miami was a great race.
Great for you guys.
A great race for us. Almost a perfect weekend.
So was Japan, right? I mean,
Japan was great. We got the safety car, unfortunately, landed at the wrong time for us, the right time for Mercedes, but that's racing.
My problem with it is if you have to lift and coast, that doesn't seem like really race car driving, but it seems like there is less of that now.
Less of that. We'll get that kind of out of the system. And anytime you need to use strategy, it is racing. And I fully get that drivers want to be flat out all the time. You do have to.
Or on the brakes, right? You want to be controlling
you want to be
load
on it.
Yeah.
But it is still very much racing. DRS, when that came out, with the movable rear wing to assist passing, that, people went, that's artificial, and then 10 years later, no one was talking about that. So I think, with the amount of lead changes, it does become
I still talk about it. I still talk about it.
He's still talking about it.
What I feel like, so it has been awesome to watch, and to Danny's credit, she has dragged me along this
strategy
this
is amazing.
year.
I mean, it'd be like arguing that tire choices aren't interesting. All of that strategy, I think, leads to more rounded and interesting sport.
The thing is, these cars have. If you're someone who's my age, or Zach's, right, these cars have grown so much bigger.
Us old.
And the aero has grown so complicated that you need to create something artificial in order to allow passing. Otherwise, it just doesn't happen.
Is that right?
Yeah, because the cars are so aero dependent and they're stuck to the ground that soon, it's like when you get on a plane, and that's why they space planes out, you get turbulence. As soon as you get any turbulence, it's hard to come up on the other cars. So we came up with DRS, which has worked great. So I think it's very much still racing. I understand exactly what the drivers are saying. I've driven the cars, so when you get clipping and then lifting and coast, you have to manage tires. Sometimes you have to manage fuel. I think the good news is it's been produced great racing, and we will smooth out this technology, so we'll have the best of both worlds.
I mean, you've always, the sport as a whole has always been kind of on the bleeding edge of technology, and you've always had really advanced analytics. Does AI change anything? How are you using it at McLaren?
Yeah, we're using it all throughout our racing team. Gemini is a huge partner of ours, so we couldn't be more fortunate to have a leader in AI helping us understand and deploy AI. We're doing it in everything from strategy to car development to business operations to fan engagement. So there isn't anywhere that we're not deploying it.
Do you have to use Gemini? Because Claude's looking pretty good in kind of their horse race of who's leading.
We love Gemini.
Okay.
They've worked wonders for our racing team, and as have all of our partners. You know, they're very integrated into our racing team now. You know, it used to be a sticker on a car 20 years ago, but now with the amount of technology in our sport, we're dependent upon the Ciscos and the Dells and the MasterCards to reach all our fans. So they're big contributors to making us win on track.
Dude, for me, having it on Apple TV has just opened up everything. And I don't know if, Danny probably had a subscription to whatever F1's thing was always, but I can now watch every single minute, and it changes everything for me.
I'm always watching on pit wall, so I have yet to see a broadcast, but the feedback that I've had, the numbers are very strong. So I think there was some initial concern on when you go to kind of behind the paywall, the numbers have exceeded last year's numbers, so that's great news. And all the feedback I'm getting has been unbelievable. And I think they're just getting started. Of course, they were behind the movie. A sequel's coming, we believe. I don't know that they've officially announced it. Maybe I just officially announced it right there. And so the sport just continues to grow and grow. It's very exciting.
And that was McLaren CEO Zach Brown. Up next, we'll break down the latest Fed minutes report with a former central bank official. We're back in a moment. U.S. now, the latest Fed minutes indicate that officials may consider a rate hike if the ongoing oil shock from the Iran conflict continues to drive prices higher. March's meeting was Jerome Powell's final session in the chair, as was former Governor Kevin Warsh, appointed by Donald Trump, now assuming leadership amid expectations by the U.S. president that he will lower rates. Let's welcome Thomas Honig, former president and chief executive officer of the Federal Reserve Bank of Canada. Actually, the meetings are from April, not March. My apologies. Thank you very much for joining us, Thomas.
Sure, glad to be with you. Looking forward to it.
Did you have a chance to look over the minutes? Your thoughts on what stands out?
Well, let me tell you, it was in some ways less exciting than I thought it was going to be, given all the discussion following the press conference of Jay Powell. But I would tell you that I was struck by the fact that literally, except for one governor, Myron, who wanted to cut rates, there's unanimity that there should be no rate change. There were slight differences, only slight differences in terms of the outlook, but they were important differences in one sense. That is, some were given, everyone agreed there's a great deal of uncertainty in the outlook, given the war in Iran and given the tariffs and all the things that are going on. That uncertainty, some were more concerned about the downside on employment. Others were more concerned about the inflationary pressures that might come from this. And they were all agreeable they should wait and see, that there would be more data by the June meeting. And then there was these three dissents who didn't want what I think is a slight bias towards ease. They wanted that taken out, and there was a lot of discussion around that. But it was really not a big, in the sense of where they should be today. There was pretty much agreement there. So that's a simple way of looking at those minutes as they came out.
Just out of curiosity, it was apparently, I guess, a record number of dissents largest number of dissents since 1992. Right. Is there anything to take away from that, or is that just the committee being the committee?
Well, yeah, I think the takeaway, the one dissent was expected of Mr. Myron. The three, that's more significant. That was three presidents. And that's a little more because it says we really think there's a good chance that we might have to raise rates, not just lower rates, because the markets were expecting that sometime in 2026 there would be a rate cut. That has gone down as a probability considerably since the inflationary breakout that we've had here recently. And having those three presidents say, "Wait a minute, we really do want to have this to be symmetrical. That it's just as likely that we are going to raise rates as lower them." And that's an important difference in terms of looking to the future. But there was not much dissent in terms of not taking any changes, making any changes at that last meeting. So for the future, yes, it is important.
And the news we're getting today, of course, I mean, it's been changing day to day, almost minute to minute, hour to hour. Does that have an effect, or do we have to wait and see how this plays out? This news that they may be close to a peace deal.
Yeah, I think we have to wait and see, because number one, everyone's wanting to know what Kevin Warsh, who's the new chairman, is going to do. They want to know how he's going to lead, where his proclivities are. Now, most people think, and I'm among them, think that he was more concerned about inflation, about not letting the balance sheet get out of control again as it grows. But how is he going to interact with the other members? And would he really consider raising rates? That would be very hard to imagine by most, given that the president wants cuts. And if he can pretty much say if the inflation numbers stay high, if he says no change, that will be, I think, an important milestone to say, no, I'm independent. We're going to leave. We're going to wait and see a little bit longer, but we're not going to cut rates as some people would like. And that, I think people are waiting to see how he conducts that first meeting.
And do you think he will say no change?
I would be a little bit surprised if he does, because for a couple of reasons. Number one, the evidence is building that a rate cut is not a good idea. Number one, the real rates, if the current Fed funds rate is 3.5%, let's say 3.6, it doesn't matter, and inflation is 4%, you have real negative interest rates, because you take, you subtract that inflation, you got a negative number there, and that in and of itself is stimulative given these current conditions. And so Kevin's going to look at that, and he has to say, well, yeah, we're below the neutral rate. The neutral rate is at no lower than 50 basis points, or 0.5%. Here we are negative. We have to wait. We really should not make a cut. That's number one. And number two, he's got another issue. He has been talking about shrinking the size of the balance sheet. But in fact, since December, the balance sheet has been actually growing, and the amount of government securities that the Fed has been purchasing is nearly $250 billion, and the reserves of the banks are still going up. So you have almost a new form of QE in here. So how is he going to manage that? He's talked in the past about reducing the balance sheet, and the balance sheet is actually growing. So how is Kevin Warsh going to deal with that in the future? And I know between now and the meeting, very little is going to be done, but it'll be a big discussion item, I would expect, at the next FOMC meeting. So it's not just the rate change or no rate change. It's what do we do with the balance sheet will be another big discussion item at that meeting, I suspect, that it should be.
Okay. We have to wrap it up there, Thomas, but thank you very much for joining us. We appreciate it. Thomas Honig, former president and chief executive officer of the Federal Reserve Bank of Kansas City. And we'll have more coming up after the break. All right, breaking news for you. We've been expecting it, but it's officially come down now. SpaceX has filed publicly for its initial public offering, moving Elon Musk's rocket satellite and artificial intelligence company a step closer to delivering the world's biggest ever debut. Potentially, the company, formerly known as Space Exploration Technologies Corp., chose NASDAQ, no surprise there, and its symbol will be SPCX, according to a filing on Wednesday. And it looks like the expected IPO date will be June the 12th. And the share price, number of shares offered, have not yet been disclosed. A 5-for-1 stock split reportedly planned to lower the per share price ahead of the debut. These are all coming from the Bloomberg terminal right now. Now, the IPO may raise as much as $75 billion, which would shatter records for new listings. And the offering is expected to value SpaceX at $1.5 trillion, possibly more. That's up from the approximately $800 billion estimated at the end of 2025. It could be the largest in history. In fact, it's pretty much expected to be the largest in history. Some of the financial disclosures here. Full year 2025 revenue, $11.39 billion. Q1 2026 revenue by segment. Space 619 million. Connectivity segment, 3.26. And the AI segment was 818 million. And it disclosed a net loss of 1.9 billion for the 3 months ending March the 31st. We'll have lots more for you about this for tomorrow, but that does it for today's program. Thank you very much for joining us. I'm Roger Peterson. Have a great evening.